Nope. Okay, so let's talk about costs. So let's just do a little bit of a recap. So we learned that there were two types of economic systems, command and market systems. We like to study market systems. We learned the simple demand and supply model. Markets have two actors, we know. We have the consumers and producers. They voluntarily trade with one another, and, we get equilibrium price and quantity. Last week we talked about consumer choice, which which gave us a little bit of a taste of consumer theory. So we got a bit of an idea of why a demand curve's downward sloping. We looked at consumer surplus. Now we're going to talk about, if you're thinking of the supply curve or the supply side, we're going to talk about the behavior of firms. So this is an important component of this is production and cost. So we're just going to look at an overall general pattern of production and cost. And the concepts that we're going to learn in this chapter are going to be used again in further chapters. So it's very important that you learn them. We're going to learn the different cost structures, and we're going to be using those. We're going to learn the overall cost structure, and that will be used when we're talking about other market structures as well, like in a monopoly, etc. Okay, so let's first begin with a discussion of explicit versus implicit costs. So any firm, when they do their profit or loss statement, in essence, they're going to be looking at their total revenue. In this example, it's $20,000. And to get accounting profit, they're going to be subtracting off any explicit costs. So these are any expenses that they incurred to generate this revenue. Okay. And so in this case, the total explicit costs were $17,200, and the accounting profit then was $2,800. Now, economists also like to subtract off implicit costs, and there's a reason for that we'll talk about later. But essentially, when we're thinking about whether someone should remain, in a certain business producing, we want to incorporate what their opportunity costs were. If their opportunity costs are very high, then they probably shouldn't be doing that, because we think of markets as a way of allocating scarce goods and services. So we don't want someone with a very scarce skill, say like a nuclear engineer, owning a sandwich shop. So their opportunity cost would be very high because they would get paid a lot for being a nuclear engineer. And so when we're thinking of whether a particular business owner is profitable, we're also incorporating implicit costs. So you could have a nuclear engineer having a sandwich shop that makes $100,000 accounting profit, but they're not going to be making an economic profit because they could make maybe $300,000 as a nuclear engineer. That would be the idea. Okay, so that's a little bit of a taste of why we care about implicit costs. So economists would further subtract these to get at what the economic profit or loss is here. So in the ongoing example here, we have that the owner of this firm has opportunity costs of $800. Maybe that's they've borrowed some money for this business so that they could get a return on that somewhere else, and maybe the owner could also get paid $4,000 by working somewhere else. So in this case, the total implicit costs are $4,800, and the sum of all of the costs would be $22,000, and so this person would be making an economic loss of $2,000. Okay, so again, explicit costs are just your typical costs that you would subtract from revenue to get your accounting profit, and economic profit is obtained by further subtracting any implicit costs. So accounting profit is, as you gleaned from the last slide, is total revenue minus total explicit cost, and economic profit goes a step further and subtracts off implicit costs as well. So there's a term called normal profit, and this is the minimum profit that must be earned to keep the entrepreneur in that type of business. So with my nuclear engineer example, if the nuclear engineer's income was $300,000, and they would at least need to make $300,000. That would be the normal profit that they would need to make in order to keep running. So perhaps these sandwiches are so good that the value that this person's adding by the sandwich shop is so large that maybe it is worthwhile for them to do that instead of being a nuclear engineer. So if they're making $400,000 accounting profit, and maybe they're actually providing more value in that than being a nuclear engineer. Okay, that's the idea. And again, the economic profit is just whatever's left over after explicit and implicit costs. A sunk cost is just something, if you negotiated a lease and you have to pay $1,000 a month for the next year, that's a sunk cost. You have to pay that regardless of anything. So you shouldn't be incorporating sunk costs when you're thinking on the margin. So we could look at another illustrative example here. So in this example, if we look at the right, we have a certain business. The area here of this rectangle, the entire thing, would be the total sales. So if explicit costs are $17,200, then whatever is left over, this rectangle here would be the accounting profit, in this case $7,800. But economists would further subtract off implicit costs. Okay, so here we have that the person's normal profit would be $4,800, and so we subtract that off, and then we're left with an economic profit of $3,000. So in this case, we have a positive economic profit. Okay, so we're going to look at some general patterns in production. So we call that the theory of production, and we're focusing here on the short run. In the short run, we are thinking that one of the inputs to a production process is fixed. The best context to understand this in, or to think about this in, is to consider two inputs, capital and labor. Capital will be what's fixed in the short run, and labor is something that you can vary in the short run. So think of a restaurant. You have fixed capital in the short run, the size of your restaurants, the number of ovens, etc. But you can hire more labor or less labor as much as you want. You can vary your amount of labor. And of course, the food and all that. But let's just keep things simple and think of labor and capital. So in the short run, again, the short run is when you have something fixed. So in our case, it's going to be capital. Now, total product would just be the total output of any productive process. So we could think of the total number of meals served in our restaurant. Usually there's some time element to that. Marginal product is the amount of production, so maybe the extra amount of meals we can get at a restaurant by hiring an extra unit of labor. Well, in general, it's any input. We'll just talk about labor. Okay, so marginal product is that amount that you get from hiring an additional unit of labor, and that's going to be different depending on the number of workers you've already hired. The formula for that would just be the change in total product over the change in labor. So if you increased your labor by 1 unit and your production increased by 10, your marginal product of that for that unit of labor is equal to 10. Now, average product is just on average how much each worker contributed to production. So we just take the total production and divide it by how many units of labor was used to make it. So if we made 10 units of output and we had 10 workers, then the average product of labor would be equal to 1. On average, each person contributed to 1 unit to total output. Of course, that's going to differ on the margin. When the first worker, if we hired the first worker, they might produce 2 units. The second worker might produce an extra 3, but then if we start hiring workers, that might start falling. So it could be different on the margin. This is just the overall average, where we just take the total quantity Q divided by L. Okay, let's look at a numerical example. So here we have on the left the units of labor. Okay, so we're this is like a what if sort of concept. If we hire, what if we hire 1 unit of labor? What if we hire 2 units of labor? And the second column will tell us how much production we would get for each of those units. So in this numerical example, if we hire the first worker, we will get a total product of 4. If we hire the second worker, we'll get a total product of 16, and so on. Marginal product is the change in this total product with respect to a change in labor. Here, the change is always going to be equal to 1. But if we had, say, 0, 10, 20, we would have to divide it by the change. Okay, so marginal product then for the first unit is simple. It's just 4, right? It's the same as the total product. And this is the formula here. So for the first unit, the change in total product is 4, change in labor is 1. So we have 4. But now when we hire the second unit of labor, we're not just getting another 4 units. We're actually getting the difference of 12. So the marginal product of the second worker is 16 minus 4, which is 2 minus 1. So that equals 12. So now this could be, so 10, generally we like to think of, at first your marginal product could increase because of specialization of tasks, right? If you think of a restaurant, you'll have a dining room and a kitchen. If you just have one worker doing both, working in the kitchen and cooking, you're not going to get that many meals output. In this example, maybe you would get 4. But if you hire a second person and have just them cooking the meals and then the other person serving the customers, you're probably going to be able to produce way more than 4. Or you're getting some returns to specialization there. So in this case, when you hire the second worker, you get much more than the first worker. You get 12. Now, if you hire another worker, you also get an increase here. Marginal product jumps to 20. So now you can do some specialization within each of the kitchen and the dining room. Okay, and then the marginal product at 4 is 24. So the marginal product here is increasing. Every time we hire a worker, we're getting more from that new worker than the worker before. And that's because of specialization. But at some point, because we're in the short run with fixed capital, this is going to start to fall, right? You can only get so much. There's only so many opportunities for specialization. At some point, this specialization is going to cease to happen. Unless we were to increase our capital, but then we're talking about the long term, and that's the next topic. So we're still in the short run. So at 5 units of labor, we notice that the marginal product starts to fall. And so we call this diminishing marginal product. And so you could think of, just in general, for any situation where you have one of the inputs as being fixed in the short run, and then you're varying another input to production, at some point you might see a pattern like this, where marginal product increases. Maybe it just never increases, but at some point, it may never increase, but it will certainly at some point fall. And then even at some point, it might even be negative. If you keep hiring workers for a restaurant with fixed a fixed size of location and all that, at some point people are going to be tripping over each other. So you could actually make things worse. Okay, so that's where marginal product becomes negative. This isn't diminishing marginal returns. Diminishing marginal returns happens when the marginal product goes from increasing to decreasing. So at this point here, and then this is negative marginal product. That's a different concept. Now, average product here is just, on average, how much is each worker producing? So when your marginal product is increasing, the average product must be increasing, right? Because, on the margin, we're getting more output per worker. This here just takes output and divides it by the number of workers. So this must be increasing as well. When this starts to fall, it'll start pulling this down. And first note that the marginal product will be higher than the average product. Well, anytime this number is higher than the average product, it's going to make the average higher, right? But then but this is falling, right? So at some point, it's going to hit the average product curve. So we'll talk a little bit more about that when we look at a diagram. So here's our average product. So for the first unit, it's going to be 4, right? Average product's the same. We've only produced 4 output. We only have 1 worker. But now when we hire the second worker, our total product, we get this boost. Marginal product increases. So of course, our average product is also going to be increasing. But on average, this worker contributed 12, but this worker contributed 4. So, the average is going to be 8 if we take the total 16 divided by 2. Okay, so this is going to be, the marginal product will be higher than the average product. Now, and you could, unless, there could be, depends on the situation, but, anyways, we can see the relationship here. This is going to be increasing when the marginal product is increasing. Now, this is also going to be increasing even though this is decreasing, but this is going to be increasing at a decreasing rate. And eventually they will cross each other and then it'll switch. So now on the margin, after diminishing returns kicks in, the marginal product's falling, and that's going to start dragging down the average product. So that's the general pattern. If we look at these in a diagram, we can see that total product would look like, so if total product looked like this, then our marginal product would look like this. So there's some important things to point out here. So in this range from 1 to 4, we see that this is convex. So we see that there's increasing, this is increasing at an increasing rate, right? So that corresponds to the marginal product increasing. So on the margin, we're getting larger and larger. Every time we hire a different worker, we're getting more and more out of them. But at the point of diminishing returns, that stops. Now, if we look at the total product curve, it's increasing at a decreasing rate. So this actually becomes concave. This is called an inflection point in mathematics. So at the inflection point, we have the point of diminishing returns. And so now our marginal product is falling, and then it's maxed out here. This doesn't look like a maximum, but this should be, a maximum here. And so at the maximum, that's where marginal product hits the 0 axis. So then any further amount of labor, actually marginal product's negative, and so that makes total product start to fall. Okay, so that's the point of maximum total product. Okay, and so what's driving this pattern again is just the idea that if we're in the short run, at some point we're going to have diminishing marginal returns because one of our inputs is fixed. This point here is the point of maximum productivity. So again here, this is our marginal product. So on the margin, this is getting larger. So that's going to start, that's going to drag up the average product. Now here, the average product is still going to be increasing, but at a decreasing rate. So this is falling, pulling this down. At some point, they're going to meet. They're going to meet where the average product is at a maximum. Now this is pulling it up, and then as soon as it intersects, it starts to pull it down. Okay, so that's why it hits it at the maximum. And so if you're thinking of a measure of productivity, well, a measure of productivity would be output per person, right? And that's exactly what average product is. It's output divided by labor. It's the TP divided by L. And so in terms of a productivity measure, that would be your maximum productivity, where your output per person is at its highest. Okay, so this is a general pattern we'd see of production in the short run. Okay, there might be all kinds, there could be different shapes. Maybe this could go on for a long time, or maybe there'd only be one, only 2 units of labor gives us an increase, and then after that we're falling. But the general pattern will be very similar. So now we just talked about production, but costs are, related to production. Production, we're using labor and making units produced. Cost, we're looking at units produced in dollars. So we're looking at the cost divided by the number of units, or cost per unit. So if and also remember that one other assumption we're going to make, which is pretty realistic, is that the price of an input would be fixed. So we're going to think that the cost of labor per hour is fixed. So say it's $10, it would be fixed. So if you think of, suppose that the wage is $10 per hour. Now you hire the first worker, they produce a certain amount of output, and you're going to have to pay them $10. But if you hire the second worker and they produce much more than the first worker, but you're still paying $10 for all that extra output, well, then your costs per unit are going to be falling, right? Because it would be your total cost, which would be $20. At first it would be $10 divided by the quantity. Then the second would be $20 divided by the quantity. And since the quantity increased much more for the second worker, the denominator is going to be grew much larger than the numerator, and so the marginal cost will be falling. So just keep that in mind. We'll get back to that in a moment. So let's define the cost variables that we will use. So total variable cost is the total of all costs that vary with the level of output. So again, you're thinking of labor as a variable cost, the flour and dough you use to make sandwiches in a sandwich shop, anything like that. Marginal cost then is just the increase in total variable cost as a result of producing one more unit of output. So if I produce one more unit of output, what's my marginal cost associated with that? So it would just be my change in total variable cost. And so the formula for marginal cost is the change in total variable cost divided by the change in total output. Oh, I just saw the question here about when average product is higher than marginal product. So I mean, if on the margin the number is larger than the average, think of a box. If you had a box and on the front of the box it showed you the current average of all the numbers that you threw into the box, right? So let's say the current average is 10 on the front of the box. Well, if you start putting in numbers that are above 10 into the box, the average will increase, right? If you put in a number that's below what's on the front, that will lower the average. So when the marginal product is above or is higher than the average product, it will be increasing it, okay? And then if it's below, it will be pulling it down, okay? All right, so average variable cost is simply your total variable cost divided by your total output. So there's kind of a these are sort of analogous to the production. So before we had total output, and then we had we had total product, and then we had marginal product, and then average product. These are, they're not the same, but they're similar pattern here. This is the total variable cost, and then this is the variable cost on the margin, and then this is the total average variable cost, which is simply the total variable cost divided by your total output. So let's look at a numerical example. So on the left column, we have units of labor, and we have our total product, our marginal product, our average product, and then we're going to add in our total variable cost, marginal cost, and average variable cost. So our units of labor are going to go from 0 to 7. Our total product is going to, this is what we had before, remember? We went from 0 to 4, then we went up to 16, etc. So we had our marginal product increasing until the 5th unit of labor. So, so diminishing returns starts to happen after the 4th unit of labor. Our average product we calculated before was this. So here we're just taking the total product and dividing it by the amount of labor. So now we're going to add in our total variable costs. So if we hire, okay, so in this case, we are assuming we're just using labor, and labor costs $120. So what would the total variable cost be for the first unit of labor? Anyone? Yep, that's right, 120. And so this is going to go up by 120 each time because that's how much a unit of labor is. And marginal cost is the change in total variable cost with respect to a change in output. So we can just look here. So when we hire the first worker, we get 4 units of output. And so we're going to take 120, which is the difference here, and then divide it by 4, which is the difference here. So the marginal cost of the first unit is $30. Now we hire another worker, we're still paying them $120. So, we increased our cost to $240. So we went from 120 to 240. So the difference here is still 120. Look how much extra output we got. We got 12 extra units. So when we take the change in total variable cost, which is 120, and divide it by the change in total product, or Q, which is equal to 12, we get 10. So of course, so when you have marginal product increasing, you will get that the marginal cost will be falling. As soon as diminishing returns kicks in, the marginal cost will be increasing because you're paying always the same for the labor, but you are getting less and less now out of it. So, your per unit cost is going to be increasing. And then here's your average variable cost. Your average variable cost, again, if you're on the if this is positive, that's going to be, if this is above the average, it's going to be increasing it. And then, so there's kind of a similar relationship, but it's a mirror image with the marginal product and total product. We'll look at it on a diagram. So here in the top, we have the production stuff that we talked about. So we have our maximum marginal product. We have our average product. Okay. So below, we have our cost curves. We have our marginal cost and our average variable cost. So here on the margin, the costs are falling, so they're going to be pulling down the average variable cost. So anytime this is less, anytime on the margin it's less than the average, it's going to mean that the average is going to be lower. But then here, on the margin, it's higher, so it's going to be pulling this up. Here on the margin, it's higher, so it's pulling this up. And anytime it's higher, it's going to be pulling it up. and then it crosses, and then now it's pulling the average down. But you can see these are just mirror images of each other. So when diminishing returns kicks in, that means you're at the maximum of the marginal product or the minimum of the marginal cost curve. Okay, and then maximum productivity coincides with the minimum average variable cost. Okay, so there's a very clear relationship between the cost and product curves. So let's define total fixed costs, because we haven't done that yet. We only looked at variable costs. So total fixed costs, yeah, they're not going to be that interesting here because they don't vary with output, so they're just fixed. They don't vary with the level of output. We can calculate average fixed costs by just taking total fixed costs and divided by output. Oh, so someone wants me to explain the marginal cost. So marginal cost is just the change in total variable cost with respect to a change in the quantity. So it's just answering the question, what would my additional cost be on the margin if I produced another unit of the good? Okay, so average fixed cost is just given by this formula. And this, of course, is always going to fall. This is constant. It doesn't change with output. So it's just a fixed number, and then if you constantly divide it by a higher and higher number, it's going to fall, right? So of course, total cost is just the sum of total variable and total fixed costs. And average total cost is just the total cost divided by total output. And again, remember that, so this is important to point out. So marginal cost is the change in total variable cost divided by the change in output. But since fixed costs don't change, you could also use the change in total cost. So the change in total cost will only, the total cost will only change because of variable costs, right? Fixed costs never change. So the change in total cost is always the same as the change in total variable cost. So you could use either one and you could get marginal cost. Okay, so it could be the change in total cost or the change in total variable cost. They're both going to be the same. So here we have a diagram of our total cost, total variable cost, and total fixed cost. So total fixed costs are always one number. And so whatever that is going to be the vertical distance between total cost and total variable cost. Yeah, we're not going to look at this is the most interesting diagram, so we won't usually work with the total cost curves. We'll work with the average cost curves. But yeah, you can see the relationship here. Total cost is increasing, total variable costs, at any point, any quantity, the total cost will be obtained by just adding the fixed cost to the total variable cost. So that's why the difference here is always just this vertical distance, which is equal to the fixed cost. So here is 30. So this gives a good summary of all of the costs. So we have total fixed cost, total variable cost, and total cost. If we take these and divide them by output, so the first one, if we take total fixed cost and divide it by Q, we get average fixed cost. So that's AFC. If we take total variable cost divided by the quantity, we get average variable cost. And if we take total cost and divide it by the Q, we get average total cost. And then we can add these two together to get average total cost. We could also take total cost and divide it by Q to get this, right? So adding these two will give you the same thing as this. So these two procedures give you the same total cost. And the marginal cost is the change in total variable cost or total cost, gives you the same thing as a result of one more unit of output. So there are three key cost curves that we'll be using. The marginal cost curve, that's here. And then we have our average total cost and our average variable cost. Now, Q1, so the minimum of the marginal cost curve, as I mentioned before, is the point where diminishing returns starts to kick in. Okay. Now, the minimum of the average variable cost is associated with the most productive output or highest productivity. Remember, if you're thinking of productivity, you could think of the output per person. So that's equal to the average product. And if you remember, average product is at its highest, so that's where you're most productive per unit, when the average variable cost is at its minimum, okay? And so that's why we say that Q2 is the most productive output. And of course, then we're going to get the lowest cost per unit. And then here, economic capacity, this is where we have the minimum average total cost. So again, so actually I should take back what I said there. So the most productive, well, if we incorporate the fixed cost now, then the best point would be here, the minimum average total cost. And so this we would call economic capacity. This is, this is where we'd want to be. This is the high, it's the best point in terms of cost per unit. And, if we are below this, then we still have some capacity to improve. You could think of it that way. This could happen to shift these curves, and they would shift together. We won't dwell too much on this. But lower input prices would shift the cost curves down, obviously, right? And you could work it out if you wanted to, just to convince yourself. But if, say, maybe think of the previous example where we had the variable cost being 120. If we had that become 100 instead, so if we said the labor costs have fell to $100 per unit of labor, then and we recalculated everything, then we replotted the marginal cost and average total cost, we would see that they would shift down like in this diagram. Okay. So if a firm is, producing Q2, they're not doing the best they can in terms of their average cost per unit. So this is output both above and below economic capacity. Again, if you're here or here, you want to get to here. So we have two examples of output being, we have one example of being above and one below, and they're above the economic capacity is just where the average total cost is at a minimum. So that's the overall concepts from this chapter. Now it's best to do some practice questions because we're going to be using these cost figures later, and we're going to use them to calculate profit and other things. So let's do our in-class exercise. Okay, so let's get started here. So last summer, Daniel started the custom-made fencing company, which specializes in building fences to meet the specific needs of his consumers. Since Daniel works out of his parents' basement, uses an old pickup, and needs only a few simple tools, his fixed costs are minimal. He measures the firm's output in terms of the number of feet per day of fence that is built. Experience has shown Daniel that different crew sizes can build fences as shown in the first table below. So here we have the number of workers in the crew and then their output. So this column here is the total product, or Q. So now A says to fill in the marginal and average product of labor columns. It says above, but it's talking about this table here. Okay, so how do we calculate the marginal product? Well, someone tell me what the marginal product is of the first worker in the crew. Yep, good. So it'd be 20. What would be the marginal product of the second worker? Yeah, it would be 60. That's right. So it would be 80 minus 20 divided by 2 minus 1. Okay. And what's the average product of the third worker? It would be 50. Okay, so this is the numbers. So in B, it says to plot the two curves. So let's just make sure we know how to plot it. So here we have the quantity of labor. So we're just going to be plotting this column with this column and this column with that column, right? Everyone clear on that? So I'll actually put that in. Give me one second. So if we plot it, it will look like this. Okay, so you can see, where they both become the same is at 4 units. So we have 4 units of labor here at the bottom, and where they intersect is this 50-50. So anyways, we have the typical pattern that we would expect. The marginal product increases, caps out, and falls. It hits the average product at its maximum. So we know everything's right, makes sense. So now this part C says, assuming that each worker costs $240 a day, wages and materials, fill in the table on the right. Okay, so what would the total variable cost be for one worker? Okay, so our total variable costs are going to be here. What's our average variable cost? So what's the average variable cost of the third worker? Anyone? Okay, well, we got to remember what the formula is. So are we dividing by L here, the change in L, or the change in Q? Oh, someone's got it right. Yeah, so it's 4.8. So the average variable cost is the total variable cost divided by, not L, it's divided by Q. Okay, so for the third worker, take total variable cost 720 and divide it by 150. Oh, that's good. That's part of the learning process. I kind of knew that would happen. So now on a test, you won't do it again, right? So, okay, so I'll fill those in. Okay, so those are our average variable costs. Now, how do we calculate marginal cost? So what's the marginal cost of the second worker? Okay, yep, good job. So yeah, it's 4 exactly. So I'll put the rest of them in. Okay, and so we'll have 12, 4, etc. Okay, now it's asking us to plot these. So I can't really plot this easily in Word, but of course, you're going to, this is going to be a little harder because the quantities, this goes up by 50, but the quantities, are sometimes in the middle. So the first point would be at, roughly around here, a little bit to the left. This is 25, right? So a little bit to the left. So we're plotting this column and this column, and then this and this and this and this. So we're plotting the Qs with each of the cost series here. Okay, so I'll get that graph and put it up for you. Okay, here it is. Okay, so there's our graph of the marginal cost and average variable cost. Okay, and yeah, we don't need to plot the total variable cost. We wouldn't be able to plot it on this in this. Well, we could, but it would be way up here, right? We're just going to do the average variable cost and marginal cost, which is what's interesting. Okay, so in E, it says, looking at the production tables, how many workers are used to achieve maximum average product? Okay, so the maximum average product. So remember the maximum average product also coincides with the minimum average variable cost. We're going to go with, so we have our average product. We're going to go with this one, right? Because this is where the marginal product cuts it. So we know it cuts it at the maximum. So we're going to do that. So it would actually be equal to 4. Okay. So the answer here would be 4. Okay. So that's where average product equals marginal product. So what output can this number of workers produce? So how much output can 4 workers produce? Yep, that's right. Perfect. Good job. 200. Okay, it doesn't like when I put it there. I'm just going to, there we go. Okay. Now, and so how did we get that? Well, we just looked, okay, at 4 workers, we would be able to produce 200 feet per day. Now it says, now from the figure on the right, what is true at the output level you gave as your answer in F? So at 200 units of output, what is true? Oh, I think there's okay, so they've actually made a mistake in the solutions. I'm just going to fix it. Give me 1 sec. Almost done. 1 sec. So yeah, the original answer had they put 50 here and shifted these all to the left, so that was wrong. So now what's the correct answer? Yeah, it's not the most clear question. They were looking for this. So minimum average variable cost achieved when output is 200. Okay, so that's that. Look at the table on the right and determining how many workers are used to achieve maximum marginal product. So how can we get that from the cost diagram or the cost table? Yeah, it's just, so when does, after how many workers does diminishing marginal returns start to happen? Yeah, so well, after 3 workers. And so it kind of begins with the 4th worker or after the 3rd. So the answer to that question is just, so the answer is 3 workers, and that's where the marginal product is equal to 70. Okay, so that's diminishing returns kicks in after the 3rd worker in this question. Okay, now what output can this number of workers produce? Anyone? Yeah, so 150 is right. And now it says, look at the cost figure again and determine what is true at the output level you gave in your answer in I. Yeah, so marginal product is at its maximum. And then what also is true when the marginal product is at its maximum. So when the marginal product is at its maximum, is something else at its minimum? Marginal cost is at its minimum. So if we look here, marginal cost is at its minimum right here at 150. And that corresponds to 3 units of output, right? 150 corresponds to 3 workers. And then we know from this diagram here that at 3 workers, we have the maximum marginal product. Okay, does that make sense? Okay, and then it says, the last question just says, this means that average product is at a, so marginal, okay, so this means average product is at a something when average variable cost is at a, yeah, so average product is at a maximum when average variable cost is at a minimum. And marginal product is at a maximum, right? When marginal cost is, at a minimum. In the last question, we realized that average product is at a maximum when the average variable cost is at a minimum, and marginal product is at a max when marginal cost is at a minimum. So again, these are sort of like the production curves are like mirror images of cost curves. Okay. So I guess it's a bit early. So I'll open it up to any questions, and we'll call it a little early today. So does anyone have any questions?